Assalamualaikum. Hi everyone. So I will continue with the second part of this lecture, chapter 6, analysis of calculating abilities. So we are still in. So for a better audio, I suggest you to use your headphones or your earphones. Okay. Now let's continue with the next part of this chapter. You can refer to page 347 in your textbook. Okay, now let's look. So this section basically will describe the several non-recurring items, including extraordinary items, discontinued segments, accounting changes, recycling charges, and special items along with the analysis and interpretation. So we will start with extraordinary items. So extraordinary items are distinguished by their unusual nature and by the infrequency of their occurrence. The vast majority of extraordinary items are gains and losses from early retirement of debt. Extraordinary items are classified separately in the income statement. Because of the stringent criteria for classification, extraordinary items are uncommon. You can refer to Exhibit 6.3 for the reports, the frequency and the magnitude of the extraordinary items. Now let's look at the accounting for the extraordinary items in the same page. To qualify as extraordinary, an item must be both unusual in nature and infrequent in occurrence. These terms are defined as follows. Now what do you mean by unusual in nature and infrequent in occurrence? Unusual in nature means that an event or transaction that has a high degree of abnormality and is unrelated to the ordinary and typical activities of the company. Then for infrequent occurrence means that an event or transaction that isn't reasonably expected to recur in the foreseeable future. So extraordinary items are reported net of tax as a separate line items in the income statement after continuing income. So when a company reports extraordinary items, continuing income is called income before extraordinary items. Any item that is either unusual or infrequent, or meaning to say not both, cannot be classified as an extraordinary item. Meaning to say they must fulfill both criteria, which are unusual in nature and infrequent in occurrence, to be classified or to be considered as extraordinary activities. Practice also requires companies to not report a certain gains and losses as extraordinary items because they are not unusual in nature and are expected to recur as a consequence of the customary and continuing business activities, such as write down or write off of receivables, gain or losses on disposal of business segment, gain or losses from sale of abandon of PPE, effect of a strike including against competitors and major supplies, and adjustment of the accruals on long-term contracts. So these are examples that might be usual in nature and infrequent in occurrence, or either one. Okay. Extraordinary items are non-recurring in nature, and analysts therefore exclude extraordinary items when computing recurring income. Extraordinary items also are excluded from income when making comparisons over time or across companies. Yet, while extraordinary items are transitory, they yield a cost on the company. An analyst must therefore include the entire amount of the extraordinary item when computing the economic income. Thus, extraordinary items that arise from a company's business operations are included when computing operating income, but excluded when determining the economic income. Now let's go to the next part, which is accounting changes. You can refer to page 251. Companies can change accounting method and assumptions underlying financial statement for certain reasons. Sometimes accounting methods are changed because of a new accounting standard, or maybe accounting methods and assumptions are changed to better reflect changing business activities or conditions. Accounting standards distinguish among four types of accounting changes, Number 1, a change in accounting principle. 2, a change in accounting estimate. 3, a change in the reporting entity. And 4, correction of an error. So we will start with the first one, which is accounting principle change. Change in accounting principle is happen when the company switches from one generally accepted accounting principle to another generally accepted accounting principle. The phrase accounting principle refers to both the accounting standards and practices used and the methods of applying them. An example of a change in accounting principle is a change in depreciation method from straight line to reducing balance. So the disclosure for this kind of activity is that the preparer or the financial statement or the business must disclose the nature and the justification for the changes of the principle. They must also disclose the effect of the changes on the direct income and the earnings per share. And in fact, they also must disclose the cumulative effects and retrospective application of change on income and EPS for the income statement years. Next will be accounting changes in accounting estimate. Right? So accrual accounting requires estimates of items such as useful life of assets, warranty costs, inventory obsolescence, pension assumptions, and uncollectible receivables. These are known as accounting estimates. The accounting estimates are approximation based on unknown future conditions. As such, accounting estimates can change. There exists certain accounting and disclosure requirements when changes occur in accounting estimates. These are first in terms of prospective application. A change is accounted for in the period of change and is applicable future periods as and when there any effects occur. 2. In terms of note disclosure. Disclose the effects of the change on both net income and income before extraordinary items, include earnings per share for the current period only, even when a change affects future periods. Next, in terms of disposing or discontinuing operations, you can refer to page 249. Companies sometimes dispose of entire divisions or product lines. When these dispositions pertain to separately identifiable business components, they are called discontinued operations. Discontinued operations are separately reported on the income statement and the balance sheet. Now, in terms of the accounting for discontinued operations, in order to qualify as discontinued operations, the operations and cash flows of the divested of business component must be clearly distinguishable from those of the remaining entity. Such a component could be a business segment, a reporting unit, a consolidated subsidiary, or even a separately identified group of assets. Judgment is involved in deciding what constitutes a discontinued component because it depends on the nature and scale of company's business, meaning to say, what constitutes a discontinued operation for one company may not for another. Companies also record gains or losses from discontinued operation when they sell their controlling stake in a consolidated subsidiary. Accounting and reporting for discontinued operation is twofold. First, for the current and prior 2 years, all line items on the income statement that are used to determine income from discontinued operations are restated after excluding the effects of the discontinued operation. Second, the effects of the discontinued operation are reported separately, net of tax, below income from continuing operations. In terms of analyzing the discontinued operations, analysis is futuristic and decision-oriented. Therefore, for purpose of analysis, all effects of discontinued operation must be removed from current and past income. The adjustment is straightforward for the current and past 2 years because companies are required to restate their income statement and report their income or loss on discontinued operations separately. With regard to a company's financial condition, an analyst must remove the assets and liabilities of the discontinued operation from the balance sheet. The cumulative gains or losses from discontinued operation should not be removed from the sheet. So this slide shows in terms of the analysis of this difficulty equation that I mentioned to you before. So as you can see, in terms of the summarization, right, in terms of analysis of the difficulty equation, first analysis must adjust the current and past income to remove effects of difficulty equation. Companies must disclose this information for the current and past 2 years. For the earlier years, in order to look for restated summary information or other voluntary disclosures. And next, take care when doing intertemporal analysis. Next, they need to adjust the assets and liabilities to remove any discontinued operations and retain the cumulative gain or losses from the discontinued operations needed. So that's all will be the second part of this video, okay, on income chapter 6, analyzing operating activities. So stay tuned to the next videos for revenues. Okay, see you again. Assalamualaikum. Bye.